RBI dividend, which was announced on Friday evening, it's more like a bonanza for the government because it is much higher than what the government estimates were. That's important. There were market estimates and there were government estimates. Government estimates are based on estimates which essentially were part of the budget making exercise, where the government in a sense had projected a certain amount of RBI dividend in their entire total kitty. So on that front, for the government, well, it's 25,000 crore more. Market, meanwhile, markets knew that last couple of quarters have been really very, very crucial because of the volatility in the rupee. The markets were hoping for a dividend of 3 lakh crore. But bottom line here is that what really matters is the government fiscal deficit number. And on top of that is good GST collection. So from a market standpoint, this is not a bad news. And Ankur has got more details on that.
Yes, Nikunj, as you were pointing out, the dividend transfer of rupees 2.7 lakh crore is much more than 2.56 lakh crore estimated in the budget. But let me remind, this estimate was not only for Reserve Bank of India, but also other PSUs. So the dividend which has come in is even much more than putting RBI and PSUs together. Expected dividend is more than that. But if you look into account what happened last year, it is 27% more than that. Last year, there was a record transfer of rupees 2.1 lakh crore, but economists are now penciling in an impact of 15 to 20 bips on fiscal deficit, and that should improve. If you look at SBI's research EcoRap, they are saying that 20 bips improvement should be there on fiscal deficit due to this transfer, and also there will be 70,000 crore more spending headroom that will remain with the government. If you talk about the contingent risk buffer, which has been revised in this year's board meeting, which happened on Friday, now this is 6% plus minus 1.5%. That gives more headroom to Reserve Bank of India. So the limit became 4.5% to 7.5% now. Apart from that, if you talk about why this kind of surplus transfer happened this time, the expectation was that there were more dollar sales, forex gain, as well as rising interest income, and that is the reason why Reserve Bank of India actually transferred this kind of amount. The expectation is there will be a surplus liquidity in the system, whether you talk about SBI's EcoRap report or ICRA. They are also saying that durable liquidity to remain surplus in FY26, which is aided by OMOs as well as balance of payments.
Ankur, we'll leave it at that, and let's welcome on board Gaura Sengupta, Chief Economist at IDFC First Bank, joining in on the show right now to discuss exactly that. Mr. Sengupta, good to have you on the show. The highest ever dividend, although the markets weren't anticipating, Gaura, a little bit more than that. But tell me, what is it that you make? And more importantly, the fact that the RBI has flagged off risks to their estimates, the fact that, they have also upped the contingency risk buffer as well this time around within the range of about 4.5 to 7.5.
So the market, first of all, thank you for having me. The market was not wrong actually in their estimate because RBI increased their provisioning. As you mentioned, the contingency risk buffer was increased to 7.5% of total assets. That's a 1% increase. So that's how the dividend was slightly softer than market estimates. If let's say they would have kept the provisioning norms same as last year, it would have actually been a 3.5 trillion rupee dividend rather than a 2.7 trillion rupee. So it's the increase in provisioning. But nevertheless, as you mentioned, it is higher than the budget estimate. The budget estimate is implying an RBI dividend of around maybe 2.3 trillion if you exclude the PSU dividend. So this dividend gives you a fiscal space of around 1.2% of GDP, but we'll need to see how the other aspects on the fiscal perform. For example, how the income tax collections perform. Is there any pickup in the expenditure side? How the disinvestment receipts perform? But yes, post the dividend, the government of India is easily going to meet the 4.4% of GDP target for their fiscal deficit for FY26, if not slightly lower.
From a market standpoint, when I say market standpoint, more like the bond market standpoint, is this like no news?
I think this is in line with expectations. It still keeps, from a bond market perspective, they'll want to know whether there is space for more OMO purchases. The dividend, as in the introduction of the show, you mentioned that it will support liquidity. Right now, your system liquidity is around 0.7% of total deposits. The governor had mentioned for transmission, you require around 1% surplus of system liquidity. So, post the dividend, by August, you can actually have a situation where your system liquidity rises to around 5 trillion rupees or 2% of total deposits, which is, for the near term, it will say that the RBI's need to buy, infuse more durable liquidity is on the lower side, but it doesn't remove the need for more bond purchases in the remainder of FY26. For example, in the second half of FY26, RBI will still need to do around 1.6 trillion of OMO or bond purchases in H2 FY26 to ensure that your system liquidity remains at that 1% of total deposits. Because what happens in the second half of the year, we see a pickup in currency leakage. So the dividend gives you a near-term boost. We're very good for your short-end yields. It also pushes out the need for further liquidity infusion by RBI to the second half of FY26.
So, in terms of the other aspects which we need to monitor, I'm just going to take a excuse me, sidestep from the RBI dividend. The other high frequency data points are looking strong and inflation is coming under control. And with monsoons arriving early, can one be reasonably assured that the next 6-month runway for macros would be excellent?
Definitely for inflation, it is excellent. Our inflation models are pointing to headline inflation around averaging near the 3%, 3.5% mark. RBI's inflation estimate is for FY26 is 4%. So RBI is in a very comfortable position to ensure that the full force of monetary policy is focused on growth. But on the growth indicators front, a good, well-distributed monsoon, not just an early monsoon, but a well-distributed monsoon, should ensure that the rural side of consumption should pick up in FY26. But that said, we still have certain risks. For example, the urban side of the economy is not doing so well in terms of consumption spend. Also, you have private corporate capex, which is also a bit tentative, which is understandable given all the trade uncertainties. So right now, both fiscal as well as monetary policy need to be growth supportive. And the good news is that inflation is more than well under control.
Inflation is under control. All right. Well, I appreciate your time and thank you so very much for joining us. I'm just going to mark the SGX Nifty.